Target's supply chain problems should be a major red flag for all United States retailers. The company's latest warning about profits for the final quarter of 2022 is triggering major repercussions across the entire sector and prompting shares of several popular retailers to crash as investors fear that a flood of disappointing results is coming even as we enter the busiest shopping season of the year. At this point, most consumers are overwhelmed by higher prices in all spending categories, and they've been changing the way they shop to adjust to a reality of lower buying power as inflation continues to squeeze the budgets of many. But that shift has sparked a ripple effect that is severely hurting retailers' bottom lines, and a weaker than expected Black Friday is adding to their financial setbacks. The shock has been so extreme that now the retail titan is in big trouble, and that's after it had already faced a 90% profit loss in the second quarter. The outlook for Target is disturbingly gloomy, and given that many of its industry peers are facing a similar situation, soon we might see an avalanche of collapsing retailers as the US economy breaks down all around us. That's what we're going to expose today. But before moving on, please give us your support with a thumbs up, and don't forget to subscribe. Target's lopsided supply chains and its continuous logistics imbalances have resulted in what retail experts have called the worst train wreck profit outlook of the year. Since the pandemic broke out, the retailer has been facing a series of problems with its inventory levels. First, it faced severe shortages that led the company to lose roughly $52 million in the fourth quarter of 2020 due to missed sales. Then, during the same period in 2021, Target had a significantly larger inventory to meet the soaring demand of millions of US consumers eager to spend their stimulus checks. Back then, the company actually beat all expectations, with brick-and-mortar sales rising 21% and its stock going up 84% from March 2020 to December 2021. That moment of big wins was followed by a dark phase of steep losses. It's safe to say that no one in the industry was prepared to experience such a sudden and impactful slowdown early in 2022. Like its larger rival Walmart, Target has struggled to pass on higher prices to consumers and has been affected by higher freight, fuel, and labor costs, as well as serious inventory imbalances that left the retailer with $1.5 billion in items that didn't sell. Consumers coping with soaring costs of energy, of gas, of groceries, and everyday necessities have little to no money for discretionary purchases. That stark reversal in consumer habits was brutal for Target, given that 60% of its sales come from discretionary spending. In the first quarter, the company was hit by a 51% profit loss, but what happened in quarter two was even more terrifying. Even after lowering its earnings forecast 2 times before the second earnings report was released, Target's executives realized that the problem they had on their hands was far more profound than they imagined. Shoppers were not interested in the items they had on their shelves, and inventory wasn't moving at all. It didn't help that their total inventory volume had increased by over 40%. By mid-spring, it was imperative for the company to get rid of these products to be able to empty its warehouses and bring in products consumers actually wanted to buy. The only alternative was to slash prices on all of these goods and take on a profit hit of 90%. When you're one of America's biggest retailers, seeing your inventory lose 90% of its value is undoubtedly dangerous for your business. At that time, many retailers, including Amazon, Home Depot, Costco, Walgreens, Best Buy, and Dollar General, were in a disturbingly similar situation. However, right now, The outlook has gone from ugly to downright horrifying as Target reports another blow on its earnings for the third quarter and issues a dire warning for profits in the fourth and final quarter of 2022. Reporting a 52% profit loss in quarter three, the retailer is still holding an excessive amount of inventory even after offering deep discounts, and at a time the whole sector is facing a slowdown in consumer spending. Altogether, Target has faced a 193% profit loss so far this year. In face of these mind-blowing numbers, there's no wonder why Wall Street analysts and many other retail companies are sitting on the edge of their seats this holiday season. In recent months, Walmart and Amazon have been canceling orders, slashing jobs, and closing locations to deal with the overstock crisis. The big problem was that this year, inventory was peaking in the spring, a period usually marked by lower product volumes at warehouses as companies prepare to receive back-to-school and holiday supplies. Retail inventories typically rise just before October and are depleted during the months that follow. Retailers must make decisions way ahead of time, as explained by Jia Zhang, a professor of marketing at the University of Maryland School of Business. For some, it's about a year ahead of time when they decide what to order and how much to buy from vendors, Zhang says. They made their predictions around this time last year when there was surging demand. They thought that demand would stick. Unfortunately for them, it didn't. To make things worse, many of the products they ordered when ports were clogged and shipping disruptions were plaguing the industry arrived far too late. Many shipments arrived later than expected, and so the stores missed out on the best-selling time window. All of that contributed to overstocked warehouses and stores, the expert added. Target CEO Brian Cornell noted that these supply chain problems won't be resolved overnight. The retailer's balance sheet is in negative territory right now, and that's shocking news, given that a year ago sales were booming at Target. Bloomberg reports that the company's operating profit margin for the quarter was 3.9%. Now that's about 50% lower than analysts' expectations. Now, Target's ability to turn a profit is being seriously questioned, and its latest warning about holiday sales is continuing to fuel investors' doubts. A couple of weeks ago, the company said it's anticipating weak results for the fourth quarter, with sales rising between 3% and 5% compared to 21% in 2021. Executives noted that inflation has eroded consumers' discretionary income. People are buying way fewer gifts as their dollar doesn't stretch as far as it once did. On top of all that, another issue Target is dealing with in terms of losses is organized retail theft, which they estimate reduced their gross margin by $400 million in 2022. The company predicts it will lose $600 million by the end of the year to these thefts. In the past quarter, the retailer's operating income was about $1 billion, a decline of 49.2% from close to $2 billion in the third quarter of 2021. Its earnings before taxes were $909 million, down 52.4% from $1.9 billion in the same quarter in 2021. Target reported third quarter GAAP earnings per share of $1.54, down almost 50% from $3.04 per share in the same quarter of 2021. After exposing the challenges that it's still facing, Target shares tumbled 17% in a single day earlier this month. The retailer's stock is down by almost 45% this year. This is very troubling news for its competitors. With its exposure to a lot of discretionary spends, Target will feel the chill first, but it will not be the only retailer to catch a cold, said Neil Saunders, managing director at Global Data Retail. Amazon CEO Jeff Bezos recently came forward to warn of hard times ahead for U.S. businesses and consumers. Buried in unwanted inventory, retailers are facing what Forbes' Madeline Halpert is calling Markdown mania. Right now, Target is selling televisions for 25% off, patio sets at 52% markdown. Gap is hawking $60 leggings for just $12. Home Depot is slashing the price of furniture by up to 45%. TVs at Walmart can be up to 19% cheaper than last year. But still, there is no consumer rush to snatch these deals. In total, shares in consumer staple stocks have tumbled by about 9% from mid-April highs, while consumer discretionary shares are down by about 20% over the same period. Target's bleak prediction for the weeks ahead also took down other major retailers' stock values. Macy's lost 8.1%, Best Buy dropped 8.6%, and Advance Auto Parts fell 15.1%. Investors are afraid that a flood of collapsing earnings will mark this year's holiday shopping season. If their forecasts come to fruition, that will be the worst holiday shopping season since the global financial crisis. According to Thomas Hayes, a managing member at Great Hill Capital, retailers' losses are showing that there's some serious weakness in the economy and with the consumer. We are a consumption-based economy, so you never want to see that, he stressed. More and more spooky recession signs are cropping up every day, ranging from cooling housing starts to shrinking GDP, all amid the Fed tightening rates. More recently, empty stores during Black Friday proved that retailers' financial nightmare has only just begun. The busiest shopping day of the year was not as busy as retailers hoped, Reuters reported. The rush to get deals and discounts just didn't happen. Employees were seen waiting inside stores for crowds that had not arrived. Crowds? I see nothing. I'm surprised. Normally it's wrapped all the way around the building. Today, no one. Retail worker Jeremy Pritchett said in an interview. It's really calm for a Black Friday, said Ariana Furman, 18, a student from Staten Island, who pointed out the lack of crowds in the retail-heavy hub. According to Bloomberg, at a Target store on Chicago's north side, the parking lot was barely half full at about 9 a.m. local time. Shoppers were greeted with $3 ornaments and discounted Christmas trees when entering, and the store seemed calm and relatively quiet. Overall, the National Retail Federation has forecast that retail sales will be considerably lower this year, at 6% compared to 13.5% in 2021 and 9.7% in 2020. November saw a significant decline in consumer sentiment, according to the University of Michigan survey. The index of consumer sentiment fell 5% below the October reading, reversing about 33% of the gain since the historic low in June. The gauge of current conditions dropped by 10.4%. All of the frenzy that we witnessed last year seems to be long gone. Even though a slowdown was expected when stimulus money faded from the system, what's really shocking to businesses is how quickly the situation changed. While supply chains were absolutely crowded in this period last year, now warehouses are full, but ports are empty. As more and more retailers cancel orders, FreightWaves reports that the cost to move a container from Asia to a major port in North America or Europe has sunk by 23% since the beginning of this year, according to maritime research firm Drury. Spot rates have plummeted even faster. Freightos said rates from China to the West Coast are down 38% month over month. FreightWaves forecasted this week that ocean shipping volumes will, quote, drop off a cliff, unquote, by early 2023 based on slumping bookings out of China. Spot van rates in trucking down 31% since the beginning of this year. Some truck drivers reporting that rising diesel and plummeting rates have already harmed their business. All of that thanks to a drastic decline in consumer demand. With thousands of retailers around the U.S. struggling financially, a bleak holiday season is likely to accelerate their demise. We may be headed to a new year of mass retail layoffs, store closures, and bankruptcies. The numbers do not look good. The feeling of dread seems to be spreading across every sector. A major shift has begun, and it looks like it's all downhill from here. What do you think? We look forward to your comments below. Please subscribe. Here's to the next time.